All right, party people. We are here tonight with another awesome edition of Mini Multifamily Investor Network New York with me and my boy Yosef. But today we have an awesome guest, Stefan Tsvetkov. This guy is the founder of Real Quant, a company that brings data-driven and quantitative techniques to the real estate industry, on a mission to add industry value through education, investment, technology, and analytics. Financial engineer turned multifamily investor, analytics speaker, and live webinar host. He holds a master's degree in financial engineering from Columbia University, and during his finance career, managed 90 billion derivatives portfolio jointly with colleagues. Wow, man. Featured on multiple podcasts and webinar events, including Elevate, Best Ever Real Estate Show, Investing in the US, etc. Host of Finance Meets Real Estate webinar series. This is Stefan Tsvetkov. Welcome, man.
Thanks, Nico.
Welcome.
All right, so we're going to let you take it away, man. So he's got some really cool slides prepared tonight, and he's going to share that. We're going to, go through it. And he says, he's open to discussions and questions throughout. So if you have questions, you could punch them in, and we will have you unmute yourself and ask those questions throughout.
Sounds great. How much time do we have, Nico, for the PowerPoint?
7 hours and typically we end by 8 o'clock if that's possible. So
okay. I'm gonna try to be quicker. Let me see. So okay. So I always struggle how to make full screen in PowerPoint versus like Adobe or something. 1 second. Maybe this one. Okay, there we go.
Perfect.
All right. So, okay. So today's topic, I chatted to as some of you in the breakout room. So today's topic, data-driven deal finding and market selection, to Nico and Yosef's request. So Nico introduced me already. So financial engineer before and full-time investor now. And I also run Realty Quant, which is a data analytics company. So today's presentation is kind of more on the analytics side. I can talk about my own investing. So I used to do condominium conversions by New York City, and I now have been doing commercial multifamily. I'm currently purchasing my third commercial multifamily as a lead sponsor. So that's my experience as an investor, and plenty of residential deals before that. And so that's that. So yes, today like deal finding, market selection. We'll go over some of those. But first, what is data-driven real estate investing? In my mind, just to give a perspective, and then kind of also what I think it's not. So data-driven real estate investing, it's like a few different, let's say 6 pillars, I would say. So one is like automated underwriting for like on-market stuff. So most people don't like on-market. On-market is if it's, there's no deals on market and so forth. But if you can underwrite thousands of on-market stuff, perhaps you might find the top 0.1%, right? So underwriting on market stuff kind of by default for me within my company, because I want to make sure I get all the data because it's free. So then off-market, commercial off-market, very, very, very useful. There's modeling for off-market inventories that can be done on the basis of rental listings data. That's another pillar. Statistical studies for markets. So statistical studies, it's kind of actually estimating downside risk, price appreciation, and doing it in a kind of a more rigorous approach than, just saying, that's the job growth number in this market, that's the population number and so forth, but more like, let's actually derive our best estimate for what that market is going to do. And so then there's like the thing that's called AVM, like what Zillow does in residential, like automated valuation models. And then there's like all this machine learning kind of like ChatGPT type of stuff. So that's been like something that I've been using partly for a couple of years already. So one is for classification, kind of condition scoring, classification of like different, basically classifying like listings and so on and so forth, and scoring their conditions, like to help you like in an automated manner screen through many properties. They could be from social media, they could be from different sources. What it's not, just kind of my view, because like many people, they say, we use data to do our investing. I don't know, is it really the case? Like what to me, it's not, for instance, like picking a very summarized report from, let's say, Marcus and Millichap or article, and that report in itself, data-driven, very, let's say, cleverly derived, but not actually interacting with that data and not getting intuition, or not having somebody on your team to do it, that you hired, wherever you hired that person, could be in Eastern Europe, Eastern Europe, for instance, Asia, or wherever, if you want to kind of save on the cost of that, but not having intuition and experience with the data, technically, like reading those reports, for me at least, doesn't result in any intuition or understanding. So that's like there. And manually underwriting deals, technically not data driven, not doing, not performing, let's say, kind of modeling of off-market inventories, but just like using them at par, like without any kind of modeling, and selecting markets with no sense of risk management, no understanding of downside risk. So it's a very prevalent in the real estate industry from my perspective, which is coming from finance. It's for me, it's kind of strange. And so, anyways, yeah. So manually gauging property values, just kind of like by by sense, which could be okay, but sometimes like some automation on top of it could help. And so these are some examples. So let's go like over deal findings. So just to put it there, like a lot of it requires coding, but again, I know that most, like 99% of people don't do coding, but again, I just want to put it out there, just kind of open like perspective to what is out there, if you will. And so from there, there's like various ways that one can do it without coding. There are no code tools and so on and so forth. So one thing I wanted to start on data-driven investing, because I saw also in the breakout room, there were, many of the people here are interested in commercial multifamily, right? So I'm pretty sure like most of you know, like, okay, the commercial multifamily, how it's valued. So it's okay, predominantly the income approach. Now, technically other approaches come into play as well, but generally income approach is the main one. So raising the NOI of a property, divided by a market cap rate gives you the value of that property. So knowing this, and suppose you want to prospect, you get from CoStar or from, Prospect Now or whatever, get feeds of various off-market deals. Let's say, I think Joseph mentioned you invest in Kansas City, for example. So that's in Kansas City, and you have like all those off-market buildings, apartment buildings that it's 100 unit, 200 unit buildings and so forth in Kansas City. Now, what can we learn about them if they're purely off-market? So they're off-market, there's no listing for them. We know nearly nothing about them. We just know how many units they have and so on and so forth. So what kind of financial insight can we get? So this is one model that I built within RealtyQuant, and it's actually it's also a product that we have. So this model is like scaling that analysis of off-market inventory. So how can it be done? So you need to have like inventories in the first place, right? So inventories in the first place can come from CoStar, Reonomy, etc. One could also technically web scrape the inventories from apartments.com. From there, you need to kind of analyze those listings. So what you want, like besides the inventories, you want to have like kind of rental listings. So rental listings, apartments.com being the biggest source, and then there are various vendors, certain vendors, for example, Data Affinity, that they compile like rental listings for you, and you can use that. And so if you have those two pieces, you have the inventory of properties and you have rental listings, and suppose you have in Kansas City 200 apartment buildings, you can now model those 200 apartment buildings for an estimate of how much value add is there in each of them. So for example, we have, let's say building called Lakeside Vista, or whichever name it has, like an apartment building, and it has, its rent is, let's say, $650. And, but the immediate neighborhood for the same property class, because you're pulling all this data, is at $700. Okay, so you see like some delta in the rent. So you can, the simplest example, you can find potentially below market rent, by simply scouring through rental listings data and doing it at scale for like thousands of off-market buildings. But you can get more insights. So if you think to what CoStar, apartments.com being owned by CoStar, right? So if you think of what apartments.com presents in their rental listings, so besides the rent level, you're going to get a sense into other income that those properties have. So you're going to see what fees they're charging for parking, for storage, for administrative application fees, et cetera, right? You can get a sense into their occupancy rate based on how many listings they're putting out there each month. So you can sort of like high level get a sense into occupancy rate, and you can also get a sense as to what utilities are being built to tenants and so on and so forth. And putting those pieces together can give you like a glimpse. It's like a very preliminary glimpse into an income expense sheet of that apartment complex. You don't have an income expansion. You don't have a deal yet. There's no listing that is put out there at all, right? This is just basically with no listing whatsoever. But this is prospecting like off-market inventories, but you already know something more about it. So now you get what ends up by doing this approach is you would scrape like thousands of apartment buildings. And I did like a lecture for my webinar where I was showing this with like 32,000 apartment complexes. And so 32,000 apartment complexes, they were all like ranked by how much value add potential they appear to show. Is that going to be the correct value add potential? No, it's preliminary. It's based off just rental listings data. But the goal is if that ranking correlates, let's say, well enough to what is the true ranking of what are the best buildings, now you suddenly have more information. So now you can decide, okay, if you're going to be calling those owners on the phone because you have a CoStar subscription and you want to call them on the phone or do whatever. And again, direct to owner is simply one approach. But if you want to, for instance, do that, so now you can focus on the top 20% of market listings in let's say in 5 markets, instead of doing like all those additional labor for many other apartment complexes that they in the first place don't have any rents upside or any upside to their other income, other revenue expense components and so forth. So this is like one approach. So it's essentially a modeling for off-market inventories. And at the end, like as I mentioned, you kind of get a ranking. So you just get a ranking, you have like 1,000 buildings, let's say, and you can, it's an estimate. So you can, like I said, you can focus. Now I know, okay, in Kansas City, these 10 apartment complexes are at the very top based off studying their rental listings data relative to the same property class, the same neighborhood. And so it's kind of like an added like financial intelligence on top of, CoStar inventories, if you will, or Prospect Now inventories and so forth. So that's one thing that I do at the one product, or not just product, it's a model that I use it in my own investing, actually, searching for apartment buildings now. And so this is one, this one like off-market type of add-on, if you will, that one can have. And it's if you don't want to be like coding it, building it, and so forth, you can go to realtyquant.com. We do have certain certain items for that can help. So from there, another thing that I found useful in my own search, again, like focusing more on the commercial side, but can be applied to residential as well. So on social media, I'm sure you guys have seen sometimes, with some reservations that, okay, there are a lot of wholesalers and so on and so forth. But, frequently there would be, okay, you can have a 50-unit, 100-unit building, even bigger sometimes. And let's say somebody just posting on social media and pitching, that opportunity. For instance, I was prospecting like a 50-unit in Iowa or whatever. I remember like a couple of months ago that was, from LinkedIn. And so how can you scale this? So one approach is to just hire somebody on Fiverr to write a script for you that web scrapes Facebook, for instance, Facebook groups. It's not super trivial to write a Facebook group script. It's not hard, but it's a little tedious, and they keep changing their website and so on and so forth. But for instance, like here above is my Facebook group, Finance Meets Real Estate. And this is a post, right? This is a post that we did today for our in-person event tomorrow. And so that post, you could have a script written, you could actually scrape it, and you could go to like multiple real estate groups, commercial real estate groups, and you could web scrape every single post. And, can have, let's say, 20,000 posts. I believe when I did it, we web scraped 3 months across all real estate groups that I'm a member of, and there were about 30,000 posts. And so that's right. And so now that's an advantage, because now what you need above that is then you need to use, again, like the ChatGPT type of things, machine learning type of things you need to use to actually find, okay, which are the apartment buildings. Or you can just hire your VA and they're going to search manually, okay, which are apartment buildings for sale that are actually in those posts. But it's a significant advantage to just have them in a table and not have to look at a single screen and scroll, and then another screen and scroll and so forth. And, it's just wouldn't be a data-driven approach. So this is something that I've had some success with. I would say that I haven't been pushing it enough. I want to develop more in this, is to be able to kind of scale finding deals online. And so another one is now on market. Okay, so on market, I mentioned at the beginning, so many people are generally skeptical, including me. So on market, most of the stuff complete garbage, right? Not useful. But think about it this way. Let it be like a very like a very small prospect that is available, not the highest returns that are on market compared to off market. Okay, but you have a very high likelihood of capturing those because it's available. You just have visibility. If you have like the biggest, like kind of like low-hanging fruit, but you don't see it, it's like it's not there, right? And so if you have like a very few things that could work, and the majority is kind of garbage, that is on market. But those very few things, if you can see them, they're available to you. You can not only see them, you can analyze them, you can fully underwrite them in an automated manner. Then that's an advantage. And so for example, another way I've been doing is doing for finding deals is, so let's say Crexy, and again, you can do it with WhoopNet, whatever. Again, I admit to the majority of there is just not, it's garbage, right? Okay, but can you find the deal? Yes, you can. I purchased an apartment complex in December that was on Crexy, and that was through actually screening, but it took a lot of work, a lot of screening indeed. But we put perhaps about 1,000 listings on Crexy in 25 states, and so Crexy for me, like personally, is like I just get their whole data. So that's like my perspective again. Like, so it just like literally get all the listings and underwrite them. Again, you don't need to know coding. You can have somebody, whichever person you have on Fiverr, to actually just kind of do it for you. And again, the benefit is then you want to get something like this. So you want to get something where, okay, if you look at the column to the right, you kind of have a ranking of value add percentage. So you kind of want to have deals that are ranked. Now, this table on the right has many more fields. It's like kind of too much to show here. But it's actually like, okay, you have like different, different number of units, buildings, and whichever cap rate has been there, and you estimate the value add. So like I would pull like in the specific zip code, okay, what are the rents? Try to estimate how much rents are below market, what value add percentage is there. So you try to estimate it. So you're screening like that, essentially, let's say 1,000 deals or 2,000 deals or something like that. So it's kind of an advantage. And again, admittedly, the majority of this is going to be useless. But you can find it top 0.1% or whatever, and find this one deal that you need, and that's kind of what you need. So you get like rankings of properties. This is automated underwriting. So with things like, again, like ChatGPT became very popular, like with things like the growth of large language models in machine learning, automated underwriting perhaps will become the biggest thing in real estate, in my view, because that's just going to be like where you don't even need to have like acquisitions analysts and hiring all these people to underwrite your deals, but you can just have it fully automated for like relatively non-trivial situations. So this is way more rudimentary, of course, here, more basic stuff compared to perhaps what the future would show. Then like just a quick mention, and I will move to the market side, a quick mention that there's just things that are out there. I'm not going to go deep into that. I'm sure you guys have heard of automated valuation models. Like, again, they got a bit of a bad name from like overpaying for properties and all that in terms of like Zillow, Open Door, etc., like to iBuyers. But it's really useful in many other. It's useful to the appraisers, lending industry, different like home value estimates and so on and so forth. So it's really used in various other aspects of the real estate industry besides iBuyers. So that is a useful tool. I was using this in residential. When I was searching for condo conversions, I would try to do like an AVM. And what an AVM is, in a simple sense, it's a machine learning regression. One of them is called GBM. So it's a machine learning regression that basically you kind of have everything numerized. And if you think like real estate is like location, the most important thing is location, right? And so location, you have it through the geo coordinates kind of numerized, but location is something that's not linear. Because you can have these two numbers for location in this place, and then right next to it is that super rough neighborhood, let's say. And so it's not a linear thing. And so because it's not linear, you need kind of this machine learning regression. And that's where it's hard for Zillow to price homes also and all that stuff. And of course, there are all the other qualitative factors for homes and etc. But even this aspect. And to do some of the screening for deals for many listings, one other, just putting out there what technology is out there. So there's a company in New York called, what is the name? Foxy AI. So they do like images condition scoring. Okay, they're actually here on this slide. So this is again like all these machine learning stuff, condition scoring for images, computer vision algorithms. The same thing done for text. So as we saw now, like while like kind of even like ChatGPT exploded, not to mention too many times, it's because like text actually turns out maybe even more valuable than images. Language is extremely important. You can do a lot of stuff with language. So this helps you. Condition scoring is like the aspect where, say you have to you want to manually look through 1,000 properties. Somebody wrote them for you. They could have been from off market or on market, wherever. You have a list of properties, and if you wanna kind of do some classifying for them, one of the aspects that's going to be the hardest one that it needs a human to do, or at least historically it did, is just because you don't know what condition are those properties. All the other stuff, some of you can compute cap rates, this and that, you can do it like automated, but the condition is a difficult one. And so some ways, like via like machine learning, you can score like the descriptions of the properties. Let's say if agents wrote what those descriptions are, you can kind of like give a score. Is it a score of 1? Based off the language that the agent used, and could be an inaccurate language, but based on that language, similar to what a human would read, the way they would read that language, is it a great condition, or is it like perhaps like a gut rehab or something like this? And the images, it's the same thing, just like with computer vision. Okay, if you get an image, is it a great property or not? So again, they're just putting like out there what technology is there that assists actually in deal finding, because I've been using like condition scoring in my own residential investing before, less in commercial. It's less useful in commercial, admittedly. So I don't use this one that much anymore. Okay, so market selection is the other topic. So market selection, it's going to be slightly different discussion than maybe what you guys have heard, the usual like job growth, population growth, income growth, this type of thing. So this is a different approach. So I just want to kind of put it. So here the approach is, it's kind of like Warren Buffett type of thing. So here it's like if you have, it's like fundamental analysis basically. So suppose you have the way like if some of you like to trade stocks, and there's like price earnings ratios in stocks, but they don't work that well in finance anymore. And for instance, because earnings are manipulated, and also because of because it's a lot of technology sector in the stock market. But the real estate though, okay, so if you want to take similar fundamental studies, and I did this at the beginning of COVID, 2020. So I wanted to understand like which markets are overvalued. Am I carrying like a recession risk? What if we enter a recession, or something like that? And so to understand like, okay, how do you measure downside risk, and which markets to invest in based on this? Like which markets are correctly valued? Like the same way as what real estate investors do very well for properties. Like they know, okay, this property is discounted, is it, perhaps overvalued, and so forth. At the property level, very well done. Everybody wants to find a deal, right? Something that is discounted. But how do you do the same thing with markets? How do you buy a market that is 5% discounted, another market that's 20% overvalued? And so this was like this study. And so I did this study for different recessions in the past 40 years. So global financial crisis. And so what it was being measured there is, okay, you have whichever market, let's say San Antonio, Texas, and you have it at the peak ahead of the global financial crisis, and let's say it's 10% overvalued. And then the question is it going to decline 10%, let's say, or what percent is going to decline? And kind of like, and the correlation that I found between, between how overvalued different, this particular presentation here, this for metro areas. It can be done. I have it for states, for counties, etc. So how overvalued was a metro area ahead of the global financial crisis? How much it actually declined afterwards was an 88% correlation. And then there's like and then gets more interesting. You go into like recessions like 1990, which was like a non-event, like the broad real estate had almost no decline. And then you look at, okay, what correlation you get there? And it was 60%. And if it sounds like, well, that's not so high. Well, but think about a market that actually was undervalued at the time. So actually at that time, you had 70% of the metro areas were undervalued. So the undervalued metro areas, they generally experience almost no decline in a recession. So they would drop like maybe 4% or even 1% or something like this. And so, okay, and so generally very high correlation of how overvalued the market is. And again, what does it mean how overvalued it is? So here I have like a small note. like indicates basically price deviation from like historic fundamentals. So the way you just do linear methods, there's no machine learning needed for this. This is like the market size, like the simplest one that anybody can do, in my opinion. And so it's like basically linear methods. You get what the income is from, let's say, Bureau of Economic Analysis. You get population and housing supply from US Census Bureau, and you get where prices are, and you try to predict where the prices should have been based off income, population, housing supply, where they are now, and this kind of deviation, how much it correlated to actual downside risk following a recession. And this table is a very big table, so I'm going to kind of like it's hold on with me for a second there, because yeah, so this table, it's what it's showing is, so left side a mild recession, right side a severe recession. So mild recession 1990 is an example, historic example. Right side, severe one is, we all know, global financial crisis, big declines in real estate. The column that is the first column is like how overvalued like different metro areas are. So in this table, it's like bundling together 400 metro areas, like all the metro areas almost pretty much in the US. So bundling 400 metro areas, if you had a metro area that was 50 to 60% overvalued, how much it declined, what was the duration of this decline, and what was the performance 10 years ahead. And similarly, global financial crisis, you had a markets 50, 60% overvalued. How much it declined? What was the duration? And 10 years ahead performance. So what this table showed was, a few things. So one is severe recession, markets that were very generally declined as much as their overvaluation. So if you had a market that was, there's kind of an inverse to it, but generally, right? So you had a market that's 50 to 60% overvalued, declined, okay, 42 from the higher number downwards, right? So generally, all the overvaluation following the global financial crisis was erased. Now, that didn't happen following 1990. So if you had a market that's 50, 60% overvalued and you got 99, that was Hawaii, for example. Hawaii, like the 3 counties in Hawaii. So they were all in this range. And they declined only like 14% or whatever, right? So it's a much milder decline. Okay, so, but what this table suggests, and I don't want to like kind of make it like kind of too gets too detailed, but what this table suggests is if you get it matters where you invest ahead of recession. It matters at what valuation level you invest. And so what one can see is that if you purchased even ahead of a mild recession, again, I want to underscore 1990s, like practically a non-event. This was like, people don't speak about 1990s real estate declining because the broad index declined 0. But even ahead of a mild recession like that, if you invest in the most undervalued bucket, less than minus 10% undervalued stuff, discounted stuff, you're ahead 10 years ahead, 10 years forward. This is the bucket that outperforms everything else. You go to a severe recession, if you purchase the less than 10% most undervalued range of markets, 10 years ahead outperforms everything else. This table is almost like physics, I think, because what it's saying is I think like real estate is very fundamental. It's almost like physics, because you have like almost perfect ordering according to overvaluation, and then at every single time point. 1 year ahead, 2 year ahead performance, 3 year ahead, up to 10 year ahead performance. It's always the more undervalued ones outperforming the other ones. And again, and so here, like, let's just kind of make it more real in terms of what MSAs are now. So this table, if you see, is at Q2 2022. So that's not the current one, but it's actually kind of intentional. One, it's easier for me because I didn't have to update it, but 2, it's actually the best because Q2 2022 was the peak in the market. If you guys are just following like zero, like the general housing market, we don't know, maybe the market's again going to go up, we never know, right? But in zero, like it's starting in May and June of 2022, a lot of the metro areas, they started declining. For instance, Austin is close to 9% down since June of 2022, and then respectively other markets. Okay, so now these are like the most overvalued markets at what can be considered high level to be the peak quarter of the market. So there is Boise, there is Austin, there are a few other MSAs in Idaho, Phoenix, Tampa, Florida, and that. And so, and again, this is just like the top 10 or something, right? Or but then, okay, so they are like in the states of Idaho, Texas, Arizona, Washington, Florida, Utah. It's Western states, Western markets, and Southern markets. It's not a surprise. It's where every investor was investing this market cycle. So it's Texas, Florida, and then Western markets. So that's where the overvaluation is. I want to point, like if this sounds like some kind of like doomsday type of thing, or these markets are very overvalued, first thing to say is if we get a mild recession, something that's 50, 60% overall doesn't decline much. It declines only 15. So it's not that scary at all, but it has underperformance. So I kind of want to get to that. The second thing is these same markets, if we get to the end of 2020, for instance, or beginning of 2021, they were not that much overvalued. So these were, again, the most overvalued ones. There was Boise. I was in 2020. If you guys saw like my podcasting, that was one of the first podcasts that I did at Best Ever. That was 2020 Best Ever, when I kind of started with real estate. And I was like sharing how Boise was overvalued already in 2020. But that was an exception. And then here, like a couple other exceptions, but generally, real estate was fairly valued. And so if I came to like this webinar and we're here at the beginning of 2021, the narrative was actually fairly valued. But then with inflation, this changed. We came to a level that actually it became overvalued. And the overvaluation is close to the 06 level. And this is kind of factual. In fact, like the broad US is around 19%. And in 06, broad US was reached 20%. So just short of the 06 level of overvaluation. Doesn't mean we're going to have a decline like that. That's a whole different topic. But just the overvaluation. Okay, so these are like Western cities plus Texas and Florida, basically this way overvalued. For some reason, I have Florida here. I don't know why. Okay, I think this was, yeah, okay. So these are like, let's say some metro areas in Florida, and yeah, most and maybe least overvalued, and they're generally, all of them are very overvalued, for example, in Florida. Okay, and then which are undervalued? So they are not attractive markets. Again, that's not to say the reasons if something ended up in this place, it was not appealing to investors. Okay, but are they, sorry, these ones. So, but are they exposed to recession risk much? No. So very low recession risk in like different markets in, New York, Pennsylvania, Louisiana, Maryland, and, Illinois, North Dakota, etc. And some fairly valued ones, across different states. Right. So one thing to note, so I think I mentioned overvaluation relative to 06. So basically 25 metro areas are more over 40% overvalued. Nearly 60% are above 10% overvalued. And there are very few undervalued. There's only 12% undervalued MSAs. Like my company, our Realty want to invest in undervalued MSAs now, ahead of a recession. This is my whole philosophy. Like that's the only thing that we do. But actually, I must disclose, we invest in under to fairly valued. So we're more like this one in this range, just because there's so few undervalued. So we actually, okay, so my last 3 deals that I'm doing, they're all in the 0 to 5% range. Okay, and there were many more undervalued markets ahead of the global financial crisis than now. And yeah, another thing, so suppose if something is overvalued, should you not invest in it? And if we didn't enter a recession and you look at a 1 year ahead basis, and we are now already maybe in a decline cycle, so it's different, but let's say we are in 2020, and you pick the markets that are overvalued, you invest in them, that may result in outperformance. So the way like here, ahead of global financial crisis, the more overvalued market you picked on a 1 year ahead basis, it outperforms. But if you take ahead of whichever those 2 recessions, let's say mild and severe one, you pick the same overvalued market and you take it on a 10-year ahead basis, it underperforms on an almost perfectly ordered manner. So this is where, that's why I'm saying it's kind of like Warren Buffett fundamental value investing type of thing done on the market side, because it's really, it matters where you buy a market. And, right. And so, but another thing I want to mention before we wrap up kind of coming to the end of this one. Another thing is, so many people I talk to, they would say Austin, okay, 71% overall. They're going to say, oh, that means nothing, because Austin has all those strong fundamentals, got all the population growth, has all the stuff. We don't care if Austin is going to decline 10%, let's say, or 15% in a mild recession, because it's the general outperformer, right? That's the narrative. That's what I hear. That's what you guys, I'm sure, also hear from other investors, right? The narrative is, okay, let it decline 10, 15%. Then it's going to boom 40% because this is the strong fundamentals place, the strong place in fundamentals, strong market, versus if you're in Chicago or something, it's not a strong market now, right? And there is a kind of a fallacy to that, if you will. So how strong Austin was is already reflected. That 71% perfectly reflects all the population strengths, housing supply situation, and income of Austin. In fact, that's how it's derived. It's the access to those same fundamentals. And so that kind of changes this perspective of where to invest, because what actually happens is it doesn't matter if, again, let's say Austin, it doesn't matter if we get a mild or a severe recession, or if we get a milder, a smaller decline in Austin. This is the secondary question. You could get a 15% decline. That's driven, by the way, by economic recovery. Like how big a decline is, overvaluation is known now. This is like the things that I'm showing here. They're actually known. They're done by Mark Zandi at Moody's Analytics. They're done by CoreLogic. They're done by, there's a study at Florida Atlantic University, and they're done by Bloomberg Economics. So all those sources, if we take the Boise, well, except CoreLogic actually, but all the other three sources and Rioticon as well. By the way, if you take that Boise is the most overvalued metro area in America, everybody is in agreement. That's been like that for 2 years. It's not changing. Everybody knows that. Okay. Now from here, does it mean that it's going to, or that Austin is, let's say, in the top as well, right? So, but does it mean it's going to decline much? No, it doesn't. But again, it is not a question of how much the market declines. It's more like a relative performance 10 years ahead. And what this study here, and this was a newer study that I did more recently, that actually went to see, okay, let alone the downside risk, what is the appreciation? Which markets are going to appreciate? And what it's saying is it doesn't pay off. It doesn't bode well or work out well to buy a market that is in the 50 to 60% range. It just doesn't do well afterwards. Even if it declines very little, like in this mild recession, it just underperforms. And so that's where, like, when I did like this lecture at my webinar, and like some of my my people, okay, they're saying like, okay, so what does this even mean? Because like here, like what this implies is that Northeast and Midwest regions, if we take the broad regions, if we get even a mild recession, again, we don't have a recession yet declared, if we get even a mild recession, they're extremely likely to outperform what is the West and the South regions. Why? Because the Midwest and Northeast regions, they're broadly in the minus 10 to 20% range, this white range here. The South and the West, they're in the 20 to 60% range. The likelihood that buying this lower level valuation results in higher appreciation 10 years ahead is very high. So now suddenly these are your appreciation markets now. So any kind of like stereotype or thinking Florida and Texas markets are appreciation markets. Yes, while we are in the market cycle, the strong market cycle, that's correct. That's also due to autocorrelation. There's momentum in real estate, and that makes all the sense. And even if they were overvalued while we're in the market cycle, they will be the strongest ones. And that makes a lot of sense. But the moment like there is a shift, the moment there, and let's say there is an NBR declared recession, that changes. Okay, and so that's kind of like what this was suggested. And so this, the implication or suggestion of like this study with all the, however surprising it might be, is that actually, if we get even the mildest recession, Northeast and Midwest regions for 10 years ahead, extremely likely to outperform. So that's about it. So again, like data-driven deal finding. So first point, deal finding, it's very useful to do like automate underwriting, model of market inventories, some condition scoring, and automated models. And market valuations, they give you kind of statistical fundamentals, Warren Buffett type of approach to market selection, and kind of like a new mindset or just a different mindset or vision for real estate investing. So that's about it. So that's my company, like a few different links. I have a data-driven investing course, market valuations data, commercial multifamily lead generation data, and if you want to get on our investor list as well, and I have a YouTube channel. So that's about it.
Wow. Thank you, Stefan. That's amazing stuff. To me, it's a little like at a high level kind of overview, because I'm not good at math, and that's why I became an attorney with the numbers. But
a lot of information there. Really,
a
really
lot of
digest.
information. Yes. But basically, it's a great tool that you can kind of oversee what markets are undervalued and overvalued, or if you're looking into overvalued markets, you kind of want to try to avoid and then look at different markets. But if you could give me an example, like how would you use this? So basically going through this one short slide, we kind of know, okay, Southeast is better. Right? Then compared to Northeast or Midwest, like what else can we do with this?
Well, but I mean, when you say Southeast is better, I mean, Southeast was better this cycle, but now in this, that's, for instance, tells you not to buy. I wouldn't buy a single thing in the Southeast now. I would not touch a deal in Florida. Like that's just, there's no way.
Is it because, okay.
Yeah. So just
But it depends on each cycle when you punch in.
Yeah, I mean, it kind of gives you, let me show, like, for instance, like, okay, let's say on the Southeast, like, so like let's say Florida, you know, so
here's
again,
what I'm getting from
yeah,
this here, kind of this, in my mind, to simplify, is that you're using data to figure out where the puck is going, so you can skate where the puck is going to be, right? So you're investing in things basically that you see years out are going to appreciate more than the things where right now there's probably a lot of FOMO in certain markets because they're appreciating within the last few years. So you're skating to where the puck is going in these markets using this data to see where that appreciation is going to be years down the road.
Right. You mean as in kind of like reversal in the trend, let's say, type of thing, right? Or that's what you're referring to, like where things would change, let's say, versus where everybody's going right now in that case, or in that sense, or like, what do you mean?
Yeah. So, and that's
yes, but yes and no, because let me tell you, like, if you take like this yellow column here, this is not, it's kind of like, this is not forecasting actually per se. Like off this column, I can then forecast. I can then say, okay, that's the two rightmost columns are forecasting actually declines in a recession for something like Tampa. Something that's overvalued this much, if you get a mild recession, will decline 13%. Now, we've already been seeing some of that, like Austin's already down 9% so far and whatever, right? If you get a severe recession, then it's like a way worse case, right? Okay, these two columns, rightmost, they are forecasting, but the yellow column, it's actually not. So the yellow column is already there. This is already built into the market. So this thing is, you know it now. This thing is, if you take Mark Zandi and he estimates it and Moody's estimates it, they're not going to say 49. It's going to be 45 or something, but it's going to be pretty close. And it is close because we've looked at their data, looked at others and so forth. And it's a very simple, like linear approach. So you can know where you're overpaying for a market. And again, that's not overpaying for a property. It needs to be kind of kept distinct. You can find a deal in this 49% overvalued market, can be 10% discounted property, but then maybe your labor from finding, because the property being discounted, it's like your business profit, right? It's like your business income. That requires labor from searching for deals, from having agent relationships, and so on and so forth. That's like your business income. Now, this is like your investing income, right? This is like your market side that doesn't depend on your business, right? And so if you have like a property that's discounted 10% in this market, but you know the market declines 13%. Okay, you're sort of okay, right? Because you found a good deal. You're sort of fine. It's not a catastrophe, but it kind of eliminates your labor, you know. So you still don't want to have that. And so yeah. So this thing is, it's not forecasting the outcome. It's already there. It's already built into the market. You could estimate it slightly different. Could count slightly different percentage, but it's already there. And from there, what you don't know is if first, when do we get a recession? And second, which is important, right? And second, what is the economic recovery? If we have a strong recovery, like 1990 here, then you get a very small decline. But again, like it's a bit of a secondary question, because what this like big table showed is it doesn't matter if how big the decline is so much in the long run, because in the long run, you bought that overvalued 50-60% market and you're underperforming. And that's what like people now who are buying, keep buying to the Southeast, or keep buying in Arizona or Nevada or Texas. That's what they don't understand. Like they actually don't understand. The reason is they don't have this kind of second order analysis. They see prices, they're looking at prices. They also look at fundamentals alone, but they don't know the interplay of prices to fundamentals. And to know the interplay, you need to compute this. This is valuation. Where is the market value versus those fundamentals? And if you compute this, then you know that, okay, now it's already, if you're buying Texas, you're already buying here at the 20 to 60% range. You're buying Texas 20, 60%. Now that makes a difference versus if you bought it in minus 10 to 20% range. And it has an implication. So that makes those previously appreciating markets, once this market cycle changes, it makes that those are the worst appreciating markets. I mean, that was the example of Hawaii. And what's important, like with this study, I think the important insight was that even if the recession is very mild, that's still the case. So that's not obvious. That wouldn't be obvious to me at all. For instance, like I would think the recession is very mild, totally different results, right? That's what most people think, that if you have Austin again here, it's overvalued, recession is very mild, prices are going to decline a bit, like here 15%, it's going to be very short, and then that market continues booming. But that's not what the data suggests. It suggests kind of like stagnant, struggling for a decade ahead. And in fact, the milder the decline is, you could get the biggest decline duration. Because one other thing is, like most people think that real estate is extremely slow, actually. So most people think that, okay, now declines, they take like 1-2 years. They don't take 1-2 years. If now markets are declining since Q2 2022, generally, if you look at overvalued, let's say 20% plus, in both the mild and severe recession, it took 4 to 6 years for that decline. Decline duration in real estate is very, very high. That's one reason why these things work. It's very fundamental, very slow real estate. It's not like the stock market. You can actually figure things out. It's actually really easy. And so you can have you have 4-6% decline duration. But where is the highest decline duration? In the mildest recession, most overvalued bucket. Why? Because in the mildest recession, most overvalued bucket, that was Hawaii after 1990. Hawaii declined very little. So Hawaii declined very little, but because it's so much overvalued, it takes a really long time to decline. Because in the meantime, like in that mild recession, fundamentals recover. It's a strong recovery because it's a mild recession. They recover and they keep catching up over these 6 years or something. And prices, they end up like the residual of those fundamentals recover. And they end up like only 14%, but it just takes even longer. It's like even more time. And so again, so this is like where it's an argument of kind of, it matters where you buy a market. So really the simple implication of this again is, if somebody tells me, let's say, if we now are already seeing declines, but we don't have a recession. So then I don't know yet because we don't have a recession, right? We need to kind of get a declared recession, let's say. But if somebody tells me, okay, the West and the South 10 years ahead would outperform, yeah, then they have to prove it somehow. I don't know how it's even possible. It's not possible. Like I would not touch a deal in Florida or Texas right now. Never. So that's like one implication. So and again, that said, there are caveats. It's not easy to invest in a recession because, to your point, who wants to invest in the Northeast? Nobody. Even I don't want to invest in the Northeast. My deals now happen to be in the Northeast, but I don't want to. Why? There's regulatory issues. Now you have to be picking the mildest towns. It makes it even harder. You have to pick all those towns. There's no rent control, whatever the mildest ones. You're still in the wrong state. It's still wrong from a regulatory perspective. It's difficult. So inherently, or even in the Midwest, right, there is a lot of there are a lot of issues and like not being the strongest market, kind of A-class type of markets and so forth. So there are caveats and challenges, but those are kind of like the labor and business challenges to, okay, that's not the booming time now, that's a recession. But do I want to take a downside risk and purchase something in Boise, just because Boise has been booming. I mean, Hawaii ahead of 1990 was the top performer. So again, like here, like Hawaii that was here in 56%, it had appreciated like triple-digit percent. This was the top state in the US. It was like, I think 150% up that market cycle. So who would think, whoever was buying Hawaii in 1990, just like people are buying Florida and Texas now. And again, they don't have anything against, it's just what the data suggests, right? Whoever was buying, Hawaii at the time, they would say this market has the strongest fundamentals. Perfectly correct. That market had the strongest fundamentals. That's why it ended up even so high performing. Performance and fundamentals have very high correlation towards the end of a cycle. So Hawaii was very high performing above its fundamentals, but also its fundamentals were very strong above everybody else. And so one would think if you're an investor, then you're picking based on population growth, job growth, income growth, that's the place to be. But if you look at the second order analysis, this is the least the place to be. And this is the place that 8 years ahead, prices were lower. So you invested in 1990, you get to 98, 8 years ahead, your prices are below where you started. And so this is like the implication of kind of overpaying for a market ahead of a recession. And so, yeah.
Hey, Stefan, do you, first of all, you're speaking my language, man. I'm a Northeast investor. I don't want to be in the Northeast, but
Yeah,
I look at a deal in the Northeast and it just pays better and it better cash flow. I've been saying it for the last year. But does your service, would you analyze specific markets? Like if I reached out to you and said, I'd like to, analyze this part of Massachusetts or this part of New York. Can you do this similar statistics for an area?
Yep, exactly. Yeah, we have reports for like 3,000 US counties, and it gives you the history. So if you say like this number, how overvalued it is, it gives you the history of this, and it gives you like where it is now, and yeah. So we have it for basically every county in the US.
I can see Yosef's wheels turning. He's coming to New York. He's going to buy some multifamily. I can tell.
Yes.
No. I mean, I just want to say this is not an argument for, again, like this is Northeast has regulatory issues. I just want to say this doesn't have to be the Northeast. Let me show you guys. Like I can show you, for instance, I'm just going to try to pull up a sheet. I think I showed this at my webinar. Like there are few, you can pick metro areas in the Carolinas and Georgia that are fairly valued. It's not a question. It has nothing to do with Northeast. There, you can be investing to the South now. In the West, if you take the West, there's indeed almost nothing you can invest in. Like almost nothing. There's almost no metro area that one can do right now. But to the South, there are many. None of them are in Florida, but in Carolinas and Georgia, there are some. So I can just kind of show you actually. So this is not an argument. This is just if we take the broad regions, is the Northeast, again, even if we get a mild recession, is it likely as a broad region to outperform in purely price terms? Yes, it is. Because again, just because of the issue of like how, at what price you're buying those other markets, that is measurably high at this point. And so, but let's say we take the South or whatever, and this is like the southern region, and let's say we say Georgia and the Carolinas, right? And these are like some metro areas. So one can buy like these metro areas are not overvalued actually. So you could go to Columbus, Georgia. You could go to Goldsboro, North Carolina, or whatever, Florence, South Carolina, Greenville, North Carolina. They're not overvalued. On the other end of the spectrum, now if you go to Raleigh, it is overvalued. If you go to some other places, and actually, okay, let me show you Florida on this one. So, but you can invest to the South. It's perfectly okay. It just depends. Here, these are metro areas. Metro areas, their valuation is very statistically valid. So this, if you saw like in the table that I had, correlation of this thing and what the clients happen afterwards was like 88% for like the global financial crisis. So metro areas are very statistically valid. If you go somewhere in the middle of nowhere and you're in the wrong state, or I'd say like where Georgia is still overvalued, it's riskier because you could buy something middle of nowhere. Counties are less statistically valid. They're harder to predict. Correlation is in the 70s actually percent because they do those. They're also useful, but they're not that useful. Like this one is like very, I don't want to say precise, but it is very useful, you know. And so if you go to Florida, for instance, it's a different picture. Now suddenly you can invest nowhere. So these are metro areas in Florida. They're in the range of 17% overvalued to 49% over. There isn't a single metro area in Florida that's not overvalued. They're all in the red. That's my kind of perspective. If you take the whole Western region, you take the whole West, sorry, that's not the way. And you have how many metro areas? 89 metro areas from 80, and actually, let me exclude California. California is actually an interesting thing. I can talk about California separately. So actually, West excluding California is like 61 metro areas. Out of them, like only whatever, how many are these? I don't see it underneath, like 8 or something, 7 or 8 are not overvalued. So almost every Western metro area is overvalued, you know, starting with some of the cities that we discussed before. But yeah, no, it's not an argument for, yeah, if there was a way to buy the whole region of Northeast versus those other regions, yeah, it's going to perform better. But other than that, Northeast had regulatory issues. No particular big reason to invest there. You can do the Midwest. Now, it seems like the capital flow seems to be going towards the Midwest now, actually, right? That's where, you know, if you guys follow even on LinkedIn, like people, they seem to relocate. Suddenly they realize, okay, rent growth actually turned negative in all those other places because, you know, of course, right? And so now suddenly rent growth is negative. So we're going to go to the Midwest, and they're not going to come to the Northeast because it has regulatory issues. So Midwest is better in this sense. But you don't want to buy also Midwest that's overvalued, let's say. And so there is, but there's see like these markets in the Midwest are quite undervalued. So quite a few under and fairly valued markets in the Midwest. And in Northeast, there are as well. So again, you could invest in each of Midwest, Northeast, South, as far as from this kind of perspective. Yeah, so again, the Northeast has, so for example, again, I'm not a fan of Northeast. It just like it happens to, for me, actually a little bit randomly, my current deal showed up here, or maybe just because I'm physically located here. So my current deal is in Ithaca, so it's a 3%. So it's fairly valued, right? 3%. It's not undervalued, you know, but there are very few MSAs that are also undervalued also. So this one is at 3%. I have another deal in Syracuse that's like 1%. And again, that's just giving you 2 New York ones. But and I have one in Paris.
I got a question. How do you factor in like migration? Like it seems like everybody's moving from the Northeast to Florida.
Yeah.
Like
Yeah.
I lived and breathed the you were talking, I'm from Hawaii, so I know what you're talking about. The 80s, we had this massive influx of the yen coming in the 80s, and then it just vanished in 1990. And you're right, the market was flat for 10 years, you know, just completely flat, the real estate market. So I'm just curious, like,
Yeah.
with the migration patterns in the country.
Well, the answer is like, if you notice, like in that thing that I was doing, the way this percentage is derived. Now, there is a way to proxy it purely based on income and prices, but the way it's derived in a more precise way, it's income, population, and housing supply. So if you're getting migration into this market, it's actually reflected, you know, so it's not hard. This is available governmental data. So you see that. So you see the effect of that on prices. And that's where the issue is, like I was saying, with places like Austin, it doesn't matter that there is positive migration. It's exceeded, like the prices are above those levels. And so, and the other thing I want to say is like, so here I had a, let me try to find something. I had a lecture like this one. So I'm going to show you like after global financial crisis, what happened in some markets that were having very strong population growth, by the way. So for instance, Okay, this is how overvalued different states were ahead of the global financial crisis. So you see the dark blue is California, Nevada, Arizona, Florida. Some of you maybe know those are the states that got really hammered. So, and these are the declines. So, okay, just remember like this table, dark blue, California, Nevada, Arizona, Florida. The declines were, I'm just trying to find it. Okay, it's not here. 1 second. Okay, the declines in dark red, California, Nevada, Arizona, Florida, right? So those markets, they were very overvalued at that time. And the correlation of like at the state level was like around 85%, 83 to 87. Okay, this same thing, this same fundamental analysis. This is the reason why it works is just because real estate is simple. Real estate is very simple. It's not the stock market with like Tesla and Google and all that stuff. It's like very simple, driven by people's incomes or whatever, right? And so that's why anybody can do this. And so basically, the example of population growth, one example, the state of Nevada. If you look at the population statistics, so this is after 07, like in the state of Nevada, population was growing. In between 2000 and 2010, in total, population grew like, I'm just trying to remember, like 30% or something in Nevada. So there was growth in population, the prices still got hammered in totally. This is not sufficient. Like population is extremely important. It's indeed like that's what most people have been following now, but the correlation of population growth and price performance is like 40%. 40% is almost like social science. You know, it's fine, it's good, it's a good thing, 40%. But 40% you can get in, you know, like somebody like Jordan Peterson doing psychologist doing like social science studies or something like this. So you could get it there too. I mean, it's not like that high. And so it's now if you pair population with other things, now with income or other, you have housing supply there, now suddenly it gets like very high, right? But again, yeah, so it's population was continued to grow. There was domestic migration patterns. I'm pretty sure they did not suddenly reverse. They were the same, but the market was just way too overvalued. And so it declined. And so it's quite interesting. And so I think the same thing now. It's not like population growth in Austin is going to stop. It hasn't stopped now, but prices are already down 9%. It's just way too high. So
That's fascinating.
Mm-hmm. Wow. Okay, Stefan, thank you very much for allowing us to look at what a different look and fresh. You know, it's just a simply different way of looking at the markets. To me, at least, I was just following the traditional way of, you know, just looking at the metrics of population growth, income growth, and crime rate, etc. But this is just different. So I need to rewatch this and kind of just change the way I view the markets. But this is fascinating data and very, very impressive. So your service, do you charge per like report, or is it by subscription basis? Like how does that work?
Right. So my company, so to be honest, I've been really busy on the investment side, but the way our market target or whatever it's called, like our sales target is actually the lending industry. So for as far as this way for investors, like what I have on the website, it's just like reports, basically reports for different markets. We have also property reports for apartment buildings, like the thing that I mentioned on like modeling of market inventories. So we have this kind of bit like lead generation type of thing. But yeah, otherwise, just reports. So like I mentioned, 3,000 counties in the US. That's what is kind of available for investors. But this is me, honestly, it's just like kind of, because I'm an investor, just kind of helping out others. That's really what this is not our customer base actually at all, because the lending industry, they really, really care about those things. Like they make one-to-value adjustments of this stuff. And investors, they're okay. If I'm investing now in this market, I'm just going to keep doing it. You know, that's just kind of my perspective, because it's just like too hard to relocate, right? Well, those institutions, they care because now they can say, okay, we're going to stop buying loans in this market or whatever. So they're like way more invested in this stuff. And so that's kind of like, that's that perspective. But yeah, to answer your question, it is